Welcome to today's video, where we'll be diving deep into one of the most tried and true strategies in the world of investing, dollar cost averaging, or DCA. Whether you're a seasoned investor or someone who's just getting started, this strategy can help you navigate the unpredictable tides of the financial markets. But what exactly is dollar cost averaging, and why should you consider it for your investment portfolio? Let's start by defining what dollar cost averaging is. At its core, dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price. This means you're consistently buying more shares when prices are low and fewer shares when prices are high, but over time, you're averaging out the cost of your investments. This approach can be especially useful in volatile markets, where prices swing up and down. By sticking to a consistent investment schedule, you remove the pressure of trying to time the market, something even the most experienced investors struggle to do. To better understand how dollar cost averaging works, let's go over a quick example. Imagine you've decided to invest $100 every month into a stock. In January, the stock is priced at $10 per share, so you buy 10 shares. In February, the stock price drops to $8 per share, meaning your $100 now buys 12.5 shares. In March, the price increases to $12 per share, so you purchase about 8.33 shares. At the end of 3 months, you've invested $300, and you now own 30.83 shares. Your average cost per share isn't the high of $12 or the low of $8, it's somewhere in between. The benefits of dollar cost averaging. Now, let's talk about why dollar cost averaging can be so beneficial. Reduces the impact of market volatility. One of the most appealing aspects of DCA is its ability to reduce the impact of market volatility. Since you're investing the same amount regardless of market conditions, you're buying more shares when prices are low and fewer when prices are high. Over time, this can help mitigate the effects of short-term price fluctuations. Avoids market timing. Dollar cost averaging removes the need for market timing, which is notoriously difficult. No one can consistently predict the exact highs and lows of the market. By investing on a regular schedule, you don't have to worry about buying at the wrong time. Disciplined approach to investing. DCA enforces discipline. Rather than waiting for the perfect opportunity to invest, something many investors fall victim to, you're consistently contributing to your portfolio. This makes investing a habit, rather than a reaction to market events. Helps manage emotional investing. Investing can be emotional, especially when markets are highly volatile. It's easy to panic during market downturns or become overly optimistic during booms. DCA helps keep your emotions in check by sticking to a predetermined investment schedule. Lowers the risk of a big loss. Instead of investing a large lump sum at one time, which could result in significant losses if the market crashes immediately afterward, DCA allows you to spread your investment over time. This reduces the risk of losing a large portion of your investment in a sudden market downturn. When does dollar cost averaging work best? Dollar cost averaging is not a one-size-fits-all strategy, so let's take a look at when it works best. Volatile or unpredictable markets. DCA works exceptionally well in markets that are unpredictable or experience frequent swings. In such cases, you take advantage of buying shares at a variety of price points, helping to average out the cost. Long-term investments. DCA is a long-term strategy. It's most effective when you're committed to investing over an extended period, such as in retirement accounts or educational savings plans. By consistently investing over many years, you can ride out short-term volatility and benefit from long-term growth. Potential drawbacks of dollar cost averaging. While dollar cost averaging has its benefits, it's important to acknowledge some potential downsides. Missed opportunities for higher returns. In a consistently rising market, DCA may result in missed opportunities. If prices steadily increase, investing a lump sum at the start would have been more profitable than spreading out your investments over time. Higher transaction fees. Depending on your brokerage or the assets you're investing in, making regular investments could result in higher transaction fees. These costs can eat into your overall returns, especially if you're investing small amounts frequently. Not ideal for short-term investors. If your investment horizon is short, DCA might not be the most effective strategy. Since the strategy works best over the long term, investors looking for short-term gains may find other approaches more suitable. How to implement dollar cost averaging. Now that we've covered the benefits and drawbacks, let's talk about how you can implement dollar cost averaging in your own portfolio. Choose your investment vehicle. You can use DCA for a variety of investment vehicles, such as stocks, ETFs, mutual funds, or even cryptocurrencies. The key is selecting an asset you believe in for the long term. Set a regular investment amount. Decide how much you're willing to invest on a consistent basis. This could be monthly, quarterly, or even weekly. The amount should fit comfortably within your budget, allowing you to invest consistently over time. Automate your investments. Many brokerages offer automatic investment plans, which make dollar cost averaging even easier. By automating your contributions, you ensure that your investments happen regularly without having to think about it. Stick to the plan. The key to dollar cost averaging is consistency. Regardless of market conditions, continue to invest on your set schedule. Over time, this disciplined approach can help you build a strong portfolio. Real-life example of dollar cost averaging success. To give you a real-world example, let's look at someone who invested using dollar cost averaging over a 10-year period. Imagine an investor who contributed $500 per month into a low-cost index fund for 10 years. By the end of that period, they would have invested $60,000. However, thanks to dollar cost averaging and the power of compounding, their investment could have grown significantly more, depending on market conditions. In conclusion, dollar cost averaging is a powerful strategy for long-term investors looking to reduce risk and maintain a disciplined approach. While it may not always maximize returns in a consistently rising market, it helps smooth out volatility and remove emotional decision-making from investing. Whether you're new to investing or simply looking for a consistent strategy, DCA is a great option to consider. And that's it for today's video. If you found this video useful, please don't forget to hit like, comment, and subscribe. And be sure to click the notification bell so you won't miss out on future content like this. Thanks for watching, and we'll see you in the next video.